Hey guys, this is Scott Horne here with the Owner Finance Network, and on this video we're going to take a minute and just kind of talk about note sales, as we call them, which is really selling a mortgage, which is a negotiable instrument. So hope you find the video really good. If you do, take a minute and like the video, please. Don't forget to take a moment and subscribe to our YouTube channel. And as we go along through this, you have any questions, comment below. We'll do our best to get to you on those as well. Somehow, years and years ago, we learned how to sell mortgages into what is called the secondary marketplace. Now, for those of you who own a house today, you may have closed your home with a mortgage company, ABC Mortgage Company. And I'll bet you 99 to 1, you never made a single payment to ABC Mortgage Company. You're now paying somebody else. In fact, your mortgage could have changed hands not just once, but several times. In fact, my home I'm in currently changed 5 times in the first 30 days. How the hell that happened, I have no idea. That's how this game works. There's an originator of the mortgage. They then sell it to another entity that's going to be a long-term holder. Boy, that could be B of A, Wells Fargo, for instance. It could be Fannie or Freddie. Could be Flagstar. And there's other entities that buy and hold mortgages as investments. And so in the investment world, we learned to play the exact same game. And you learn that a mortgage is a negotiable instrument under the Uniform Commercial Code. There is a science to selling mortgages. There's a lot of things that affect the mortgage and what you can sell it for and what you can get for it. The marketplace, the time, the current interest rates, all these things affect pricing and structure and those items. But before you can sell a mortgage, you got to create one, guys. No, you can't just sell something you don't have. And so what we learned a long time ago is how to buy investment homes and then sell them with seller financing. And oftentimes, of course, we'd be doing rehab in the middle, so we'd be in these homes, maybe in the, I'll take it back to the very beginning. We were in our houses, purchase price and repairs at 50 cents on the dollar. And we would sell these homes to our back-end buyers. But when we sold them, we did very minimal processing. We would get an application, maybe a verification of rent, verification of mortgage. This is back in the early 1990s, so yeah, eons ago. We had very attractive interest rates on them. We would sell you these things. Usually what we learned was you needed what was called seasoning and a pay history. That means a certain number of months, and that magic number of months starts at 12 and really gets good about 24, even better about 36 months out. But if you want to eat, sometimes you got to sell them and take a bigger discount. Now back then, the marketplace for this product was only about 76, 78 cents on the dollar, meaning if the house was worth, whatever the mortgage was a $100,000 mortgage, they were paying us 78 cents, 76 cents for this loan. But guys, we didn't care because we bought into it at 50 and even got a little bit of a down payment. So we were making out like a bandit. But then we also learned that if you sold them in larger quantities, you got a bump because instead of selling a $100,000 mortgage, we were selling a $1 million pool or a $2 million or a $5 million. Well, of course, the problem with that is you had to have a way to hold those and create seasoning. So we had to create banking lines of credit and these kind of issues along the way. But then you also started to learn, well, if you want to maximize your dollars on these note sales, you needed what we kind of called back then a pretty package. Remember, back in the 1990s and even the early 2000s, we didn't have all these requirements today of the SAFE Act or Dodd-Frank Act, items of that nature. It didn't affect the owner finance industry at all. And these other compliance issues were non-existent at that point in time. And so it was a great little game to play. But what we did learn very quickly was if you had processed your buyer, got an application, got a credit report, tax returns, W-2s, 1099s, just like you do today using the RMLO for processing a buyer, same thing back then. So we started processing our buyers a long time ago because there wasn't the RMLO, so we did internal processing, kept our own pay history through our accounting system and that we were able to provide to our note buyers out there. And all of a sudden, that pricing went up from $76 to maybe 82 cents on the dollars. Well, guys, 6 cents, percent on a $5 million package is a big chunk of change. So obviously you needed to find ways to maximize dollars. Also, you start to learn if you can wait just a little bit and not sell it at the very beginning of your 12-month seasoning. If you can wait for that 24-month seasoning, then that price went up maybe to 85, 86 cents on the dollar, maybe 87 cents, because you had a more valuable commodity. And we started to learn how to play the game of selling mortgages. Yeah, we had to buy the product, create it, sell the property, and create the owner finance mortgage on it, process that buyer, and then hold it and manage and service that debt until it came time to sell it. And we learned the note sale game along the way, and since then we've sold anywhere from $400 to $500 million of mortgages into the secondary marketplace. It has been an awesome business, and of course that changes again with the time in the marketplace. Of course, when the real estate crash hit in 08-09, boom, it disintegrated everything. Now, what I found really interesting talking about a note sale is what the market did with our paper. Back in the 1990s, our average interest rate was probably 12%. Didn't have some of the rules and regulations we have today. The existing mortgage rate was about 6%. And so what we found out that these note buyers were doing is they were buying maybe a pool of mortgages from us for, let's say, $5 million. That's a lot of properties back then, guys. And they were taking that $5 million pool of mortgages and they were blending it with maybe a $50 million pool of A-plus paper. Of course, our mortgages would be classified as C paper. At least when they bought it, that was their classification. But they'd take it, blend it in, and then they would go and they would securitize it. Not really sure what that mechanism is, but it's really certifying the overall package to make it a tradable commodity out to Wall Street. Now, our C mortgages became A mortgages, believe it or not, is what I understood. Our interest rates were 12%, and over here we had $45 million of 6% mortgages. We actually raised up that interest rate from 6 to 6.5%, 7%, I don't know the actual math, but enough that made it very marketable, because that 1% raise in the interest rate may have been millions of dollars of profit to the guys selling these out onto Wall Street. Learning how to buy a property and create a mortgage is so important to do, and it's a great tool to learn in the creative finance world. It's one of the exit strategies that I think you need to learn to employ to be a truly successful investor. Today, there are many note buyers. There are commercial note buyers, could be banks, other corporate entities that buy mortgages as their business. There are IRA individuals who want to buy mortgages and hold them in their IRAs. And everybody's a little bit different. But one of the things I find that is so important today is because of all the new rules and regulations, you better process your buyer using the RMLO, the Residential Mortgage Loan Originator. They want to see that that loan was properly originated, that the buyer had the ability to pay at the time the loan was originated. I've done some podcasts with some note buyers out there from a national basis, and they're asking me, what is it we need to know about this? And of course, the very first thing is you better know what the SAFE Act says, because if you live in any state other than Texas, the SAFE Act applies the very first time to a property being sold to a homeowner, where you're carrying back the note on the property, which requires you to provide them the RESPA disclosures, which is why you want to utilize the loan processor. That's what the loan processor does for us. They go out and they gather the financial information from the borrower, put it into the computer system, and give you this nice, neat little printout with the credit report, so you can review that and make a quick, informed decision based on their debt-to-income ratio. But at the same time, that loan processor is also providing the borrower their loan estimate, as well as all 36 RESPA disclosures. Now, guys, RESPA is the Real Estate Settlement Procedures Act, which is a requirement for the disclosures to be provided to a home buyer. You go through this, and in today's note world, if you're going to sell your note, if you want to get maximized profit at least, you better have processed your buyer, and make sure that that loan was originated properly, and you didn't simply originate it in violation of the SAFE Act. If you did, you may not be able to sell that mortgage, or if you do sell it, it's going to be sold at a substantial discount because there's some risk that could then go along with it that the end buyer could possibly be taking over when they buy that note. Understanding some of these little nuances is so important. Now, when a note buyer is going to look at buying your note, they're going to look at many things. They're going to look, first off, is what is today's market value of that property. They don't care what it was when the loan was originated, because that doesn't have a thing to do with anything today at all. What they want to know is what's the value today. Then they want to know is what is the loan balance that the buyer has on the property, and what was the buyer's down payment. Was it reasonable? Now, the marketplace likes to see a 10% down payment because that means that the buyer has a legitimate skin in the game. They like to see a pay history. They know that they have a commodity that they're buying that truly works. They want that the buyer's been there, that they've been in the property, that they've been paying on time like anything else. And all these things will help you maximize dollars. They're going to look at the interest rate on the property because these note buyers want to have a certain yield. Maybe they want a 10% yield, a 12%, a 14%, a 16% yield, whatever that might be. And they're going to make their offer based upon that yield structure that they're looking at. Now, if you're only selling one mortgage at a time, that might have a different play into it, as opposed if you're selling several at a time, you can maximize your dollars because you're making the job of that note buyer a little bit easier. So all these things weigh into your profitability when you're playing the note game out there. Other things you can do is you can, like in my offices, we like to bifurcate our loans. Instead of selling 100% of my loan at, let's say, 85 cents on the dollar, so I'm getting a 15% discount. I don't like a 15% discount. I don't even like a 10% discount. I might sell off my first lien mortgage at 70 cents on the dollar, and I'll keep the 30% second lien. Now, when I do that, I might get 100 cents on the dollar for my 70% loan, or 98, but my discount has been greatly minimized at that point in time. Now, normally when I do that, sale of that 70% mortgage pays off my debt because it, combined with the down payment I got, usually equals to what I'm in the house at. So that means my 30% owner finance mortgage I'm carrying back, so it's like an annuity I just created with this income coming in for the next 29, 28 years, whatever it might be. That's another way to look at it. Now, in the industry out there, a lot of times they'll talk about selling a partial. Well, they'll buy a piece of your 100% mortgage. Now, in that case, you're assigning the entire mortgage to your note buyer, and you get it back 5 years later, 10 years later, but usually more like 15 years later, so long as they've captured all those payments. But if the buyer defaults, you're out. You don't have anything. The whole loan is gone, and maybe that company that bought your mortgage, they were able to buy that property back at a much cheaper discount. So I kind of don't like selling partials per se because of that reason. I'd rather bifurcate my loan where I sell a 70%, 75% of my first lien, and I keep the back end second lien out there. Obviously, you want to work with your loan servicer and stay on top of things. So if the borrower is not paying, can you foreclose on your second lien? Yep. Can you keep paying that first lien and keep those payments alive? In most cases. These note buyers, when they buy this, they just want that income stream is what they're buying along the way. They're not in the game to own the real estate in most cases. So you could actually foreclose on the second and then service the first. So it's a good way to think about that game and play that game in the note world. But taking some time to research the sale of mortgages, what is out in the marketplace, who can you sell to, what's the going rate, talk to other note buyers, note investors. There are people that train you in how to buy and sell notes in the marketplace as well. And getting a good glimpse of the note world gives you another exit strategy in the owner finance world, and that's something that we look at so often when we're doing these transactions, is we're always looking at the what if factor. What if I got to get out of this deal? Can I sell my note to somebody? You know, and at what discount can I sell it at? And guys, I'm going to tell you that there's always a buyer for paper, because when they buy the paper, they're also buying the property in the event of a default. There are big companies right now that'll go out who will spend $500 million, $1 billion at a time in order to buy these defaulted mortgages from the Fed. They'll buy them from Fannie or Freddie, whoever it might be out there, or FHA. Maybe these are home equity loans and things of this nature, that they're in default, various situations, and Fannie, Freddie, et cetera, they just don't want to deal with the foreclosure issues. So they sell these mortgages off at huge discounts to these big note buyers because they're buying it at this great premium. Then of course what they do is they break them up into small packages and sell them off to guys like us who buy the notes, and then we go do all the dirty work of foreclosing, taking care of the issues and those kind of things along the way. So they make their money selling the mortgages. Maybe they're able to resurrect it in some format, or we buy it and go do the foreclosure and get the property and then do whatever we do with it out there. But learning how the note game works, what the various opportunities are, how you sell it, how you originate it, the processing, what you need to be looking at in order to sell it. You know, thinking that you can sell a mortgage at 6% interest rate and go sell that mortgage in the marketplace, that is not going to work, because most investors are wanting minimum 10%, but usually 12 to 14% rates of return when they're putting this kind of money up and buying these notes out there. So if you've got some really low interest rate, you're going to get cut off at the knees when you sell that mortgage. So you need to keep that interest rate to your buyer probably at 9% right now, maybe even a little bit higher, in order to get an attractive return on the back end in selling the mortgage. So I'm just going to stress to everybody out there that taking the time to research the note sale game, as we call it, all that goes into it is a phenomenal strategy. It's a great way of doing the business, because unfortunately you can accumulate a lot of assets, but you can't spend equity, as we say. So sometimes you got to find a way to generate some cash. And this is a great way to maximize those dollars along the way. So guys, I hope you liked this video. You found it very helpful. If you did, like the video. Don't forget to comment below, and jump over, guys, and please join our YouTube channel. And as usual, again, we'll see you guys next time.